The most simple asset allocation decision is the allocation between risky and risk-free assets. In this learning objective, we examine capital allocation calculations based on that asset allocation decision. So many investors are faced with this decision, that is to split their wealth across different asset classes, where the two asset classes are a risky asset and a risk-free asset. For risk-free assets, we might consider this to be government bonds or bank bills, for example, and risky assets we might consider to be some sort of share portfolio. So for now, in this particular case, we're going to consider that we've got three potential assets. Those three potential assets are BHP shares and Foster's Group shares. Those two assets comprise our risky portfolio. We've got bank bills, which is our risk-free asset. And we're going to call P the portfolio of risky assets, which is the combination of BHP and Foster's Group. Now, for now, we're going to take the weighting of BHP and Foster's Group in this portfolio as a given. Okay, that's the security selection decision where we decide how to weight those assets, and we leave that for future learning objectives. What we're saying for now is we're going to imagine W1 is the weight in BHP shares. Hence, 1 minus W1 is the weight of our risky portfolio in Foster's Group. So our complete portfolio C, after engaging in our asset allocation decision, comprises an amount Y invested in our risky portfolio. Remembering again, our risky portfolio is just a combination of BHP and Foster's Group shares, and an amount 1 minus Y, or the balance, invested in that risk-free rate, F. So we can expand on that. Given we know P comprises the BHP and Foster's Group shares, we can expand B from our previous slide, whereby P is the weight invested in BHP and the weight invested in Foster's Group. Now, the first thing to note here is that the asset allocation decision and the security selection decision are actually independent of each other. So changing our security selection does not need to necessarily change our asset allocation. Okay, why is that the case? Well, I can change the weightings in W1 here, which is changing my security selection decision, changing the relative composition of portfolio P, and I can do that whilst having no effect at all on Y, the proportion that's invested in my risky portfolio. So this is an important note. Asset allocation and security selection are independent of each other. We can look at a numerical example that proves this. Let's imagine that we currently have 70% of our total portfolio of $300,000 invested in our risky portfolio and 90% invested in the risk-free rate. Let's imagine that of that $210,000 that's invested in the risky portfolio, we've got 54%, which is $113,400, invested in BHP, and we've got 46%, which is $96,600, invested in Foster's Group. Okay, so our Y's up here, this is our asset allocation decision. This is the proportion invested across each asset class. And our W's, that's our security selection decision, because within the equities asset class, that's the weightings of each security that we have selected there. Now, just goes to show that these two decisions, asset allocation and security selection, can be independent of each other, because what if we suddenly decide to change the weighting across our risky portfolio and our risk-free assets? So we change our asset allocation decision up here, such that we've now got 56% in the risky portfolio and 44% of our total wealth in the risk-free rate. So we can affect that change without affecting security selection decision by simply selling down the risky assets in the same proportion as what they were previously held. So if this $168,000 that we now have in our risky portfolio comprises $90,720 in BHP shares and $77,280 in Foster's Group shares, we can actually see down here that we have the same weighting across those two securities as we did before. Okay, so despite the fact that we changed our asset allocation decision, we don't have to change the weightings in terms of security selection. So it's important to note how to calculate both the expected returns and the risk, remembering being measured as either variance or standard deviation, for our complete portfolio, where our complete portfolio is the combination of the risky portfolio and the risk-free rate. So with respect to expected returns, the calculation is always the same. Expected returns are always calculated as the weighted average of the parts of the portfolio. So in this particular case, expected return of our complete portfolio is simply the weight invested in our risky portfolio times the expected return on the risky portfolio plus the weight invested in the risk-free rate times the risk-free rate of return. And that formula is always the same. It's just, as I said, the weighted average of the parts. So if, for example, we have 75% invested in our risky portfolio and 25% in the risk-free rate, and if the expected return on the risky portfolio was 17% and the expected risk-free rate of return was 7%, then expected return on the overall complete portfolio, down here we can see is 13%. Because we've got 75% invested in an asset with an expected return of 15%. We've got 25% of our wealth invested in an asset with an expected return of 7%, which is where we get our overall expected return here of 13%. That's expected return calculations. What about variance? What we know is that we can calculate the variance of a two-asset portfolio using the formula that we see on the screen here. The weight of the first asset squared times the variance of the first asset plus the weight of the second asset squared times the variance of the second asset plus 2 times weight of the first asset, weight of the second asset, and then the covariance between those two assets. But where the two assets comprise a risky portfolio and the risk-free asset, as we have in this particular case, we actually get a special case where we can actually reduce this formula down. Why is that? Because what we know is that the risk, or the standard deviation of returns of the risk-free asset, is 0. By definition, it's risk-free. Hence, standard deviation of risk-free asset here, this becomes 0. So this whole term becomes 0. Similarly over here, standard deviation of the risk-free asset is 0. Equally, the correlation between a risk-free asset and any other asset is also 0. So a couple of zeros in here, but multiplying by 0, this whole term becomes 0 as well. And what we're left with is that the variance of the complete portfolio is just the weight times the standard deviation of the risky portfolio squared. If I take the square root of both sides, the standard deviation of the complete portfolio is simply just the weight invested in the risky portfolio times the standard deviation of the risky portfolio. So it reduces down to quite a simple formula. To see this again in terms of our numerical example from before, remember we had 75% of our wealth invested in the risky portfolio, and let's imagine the standard deviation of returns of that risky portfolio was 22%. Well, then the standard deviation of returns of our complete portfolio after our asset allocation would be 0.75 times 22%, or the standard deviation would be 16.5%, 0.165. We can also think of the same thing when we look at the capital allocation decisions with leverage. So if we can assume that we can borrow and invest at the risk-free rate of return, when we have leverage, all that means is that we have a negative weighting in our risk-free rate. The negative weighting means that we're basically borrowing more money at that risk-free rate and investing more than 100% of our return in the risky portfolio. So let's say in this particular case, we're going to say that the proportion invested in our risky portfolio is 1.5. That means we're investing 150% of our initial wealth in the risky portfolio. How do we fund that? We fund it by borrowing at the risk-free rate, so we've got a weighting of minus 0.5 in the risk-free asset. Remember, our weights always have to sum to 1, and we can see here 1.5 minus 0.5 sums to 1. Now from before we said that the return on the risk-free asset was 7% and the expected return on the risky portfolio was 15%. So with this different example, what we can see here is we can calculate the expected return of our complete portfolio as simply 1.5 times 15%, so the weight in the risky portfolio times expected return of the risky portfolio, and then minus 0.5 times 7%, weight in the risk-free asset times expected return of the risk-free asset. So in this particular case, our expected return now has become 19%. Okay, so by using leverage, we've increased our expected return. But what do we know about increasing expected return? We tend to also increase risk. So in this particular case, we can also calculate the standard deviation of our complete portfolio using the same values as before. Our standard deviation of the complete portfolio in this particular case is 33%. Okay, so what have we actually done here? Well, if we think about our capital allocation line, our capital allocation line is where we've got P, our risky portfolio, RF, our risk-free rate. At the point P, we've got 100% of our wealth invested in that risky portfolio. And basically we can just shift up or down that line. So when we invest part of our wealth in the risk-free asset, we're moving down this line here. When we're borrowing at the risk-free asset and investing more than 100% of our wealth in portfolio P, we're moving up this line. Now this capital allocation line is actually quite important. Something we've actually seen before is that the slope of this line is the Sharpe ratio. And because every point on this line will have the same Sharpe ratio, we are theoretically indifferent between the two. Okay, so the average investor should be indifferent to any point along this line, but any individual investor might have preferences to being at some point along this line, depending upon their attitude toward risk. And that's where the asset allocation decision becomes important. It's deciding between each of these investments and deciding, according to the individual characteristics of the investor, which point along that line should they be on. Now, one final point to note is that thus far we've looked at a theoretical example where we've said that we can both borrow and invest at the risk-free rate of interest. However, more realistically, we know that interest rates that we can borrow at are higher than interest rates that we can invest at. So if we actually look at this idea of a capital allocation line in reality, what we find is that the capital allocation line is kinked. And that kink represents the fact that the interest rate that we borrow at, up here above P, is actually higher than the interest rate that we can invest at. So we actually earn slightly lower returns compared to what we would if we could borrow at that risk-free rate of return. So that's an example of looking at the asset allocation decision where we combine a risky portfolio and a risk-free asset.